Great to have you with us. U.S. markets waiting for signs of what's next from the U.S. Federal Reserve after last week's 50 basis point rate cut. We're joined by Diana Avigdor. She's portfolio manager and head of trading at Barometer Capital Management. For more on what she is watching, Diana, always great to see you. And how would you describe the mood of the markets? Generally speaking, this has been quite a resilient market, and we are coming into this week trading around all-time highs.
Good morning, John. Thanks for having me. Yes, indeed, we're close to all-time highs, and the Fed cut 50 beeps. Doesn't happen all that often to cut rates into a strong economy. We watched the City Economic Surprise Index that has also stopped going down and started going up. So between now and the next FOMC meeting, the labor market numbers are going to be very important. We're also watching earnings that are coming up soon. Earnings have really been the driver of this market so far, and the strength as it's been coming in better and better.
And so how would you, when you look at the trends that we're seeing in this bull market, what really stands out for you in terms of just the action in different sectors?
Seriously, it is the sector rotation has been kind of lockstep. What you have utilities doing a little better, then they stop, and you have energy doing a little better, like last week, and then tech is lagging a little bit, but it has also taken back some of its 1 month ago weakness. So it kind of rotates, and it rotates often. And so the portfolio that we run right now is pretty diversified, and we cast a pretty wide net from that perspective.
And what are your expectations for, after what we've already seen, what happens from here? Do you think that rotation continues? Are there other factors to watch, including what you just talked about, whether it's central bank policy, other things to really be digging into as we move, call it from September into October?
There really is. So we have a month end, which for traders and portfolios that tend to rebalance is an event. And we had a quad witch, an expiry, and a rebalance on Friday. So that was a lot of activity and volume on the tape. But we also have an election coming up, and then the FOMC again. In terms of the election, we might be a little directionless for a while, just because markets don't like unknowns. But when the unknown becomes known, that is after the election, and just a couple of days after, we're going to have another FOMC. And again, we're going to talk about whether it's going to be 25 beeps or 50 beeps. And of course, Bank of Canada as well, same conversation, 25 beeps or 50 beeps. Once we get through these catalysts or these events, then we go into year end, maybe about 40 days into year end, and we've cleared the elections, we've cleared earnings, we've cleared central bank rate cuts, and we'll see whether the market continues in its rally. It will, of course, depend on what economic data we get in between now and then.
Okay, so we'll watch all of that. What kinds of stocks individually might sort of speak to the trends that you're leaning into right now? Let's say, for example, the interest rate environment, companies that are worth considering from that vantage point. Are there any good stock examples out there?
Right. So it's no secret that we're tilted to interest rate sensitives, and that we have had an overweight in financials for most of the year. And to be clear, overweight financials doesn't mean just banks. It's money center banks, it's insurance companies, asset managers, that sort of thing. So even the financial portfolio is a diversified portfolio. But in terms of maybe weighing a little bit more on the interest rate sensitive stocks that benefit from a declining rate environment, we've actually added a REIT into our portfolio as of late, KMP units, Killiam. The portfolio is heavily concentrated in Atlantic Canada, which has seen a spike in population growth driven by immigration, and the valuation looks attractive relative to peers. The earnings of this company have lagged peers, and so it's reflected in its current valuations. But looking out to 25, we see strong operational fundamentals and a more favorable refinancing environment, which benefits this company. We also added to Visa, primarily because it is a steady earnings grower. And like I said, we've taken the risk out of the portfolio a little bit. We're really mindful. It's been a great year and it's a great performance year, and we don't want to give any back for fourth quarter. So we want really steady earnings growers in the portfolios, larger caps. But not necessarily we don't necessarily take something out because it's not large cap. But Visa, for example, steady compounder of earnings, and they've been successful in high margins. So we've added to that, and we've added to actually some of our banks and utilities, particularly. There is a lot of headlines on the utility side, data center conversations, power generation profile of nuclear, stocks like Nextera, Southern, and in Canada, Enbridge and Hydro.
Okay, a lot of